title of the book is called SIP, Just an Average Story. I mean, just an average story where when we say, when we watch a movie, at times we come across people saying, "Oh, it was just an average movie. Okay, don't waste your time." When we discussed a particular cricketer, oh, he's just an average cricketer. Don't think he will perform well. When we talk of a child, even a child, oh, she's just an average student. She's not that great. So we, from our childhood, we have been taught to treat anything that is average as in a harsh manner. I mean, we are told that average is bad, but there is an exception. I mean, the world of equity investing, the average is good enough. It's not just good enough. It is one thing that you should strive to achieve. Let me repeat that. Average is not good enough. It's not just good enough. It is something very difficult to achieve, and you should strive to achieve by not doing so many, by following certain practices. So that is the power of averages. So Michael Jordan, the quote of Steve Jobs, or various people, they have said that the quote from Michael Jordan goes like this: "All I knew is that I never wanted to be average." Steve Jobs says, "Never settle for average. I mean, try to be superior than that." There's another quote: "Success and average don't have anything to do with each other." I mean, we have written in red. It says, "Warning: getting inspired by these quotes can be actually harmful for individual investors in the world of equity investing, because the moment you try to do adventurous things, because it is not in your control, things are not in your control. I mean, not settling for average is maybe great for a sports person, but not in this field. I mean, so our argument is that average is not just good enough, but it is the thing one should strive to achieve as far as equity investing is concerned. So rupee cost averaging, you've heard about it. It's nothing but SIPs. So rupee cost averaging is nothing but SIPs. So throughout the COVID, for instance, the market fell. And I'm just giving you an example of, say, HDFC, Flexicap, or any equity fund for that matter. I mean, you would have done reasonably well had you done an SIP. If you look at this chart, for example, can I write on this? I can't write on this. Okay. If you look at this chart, the blue line is the fund's NAV. Fund's NAV did take a dip in the month of March 2020. Look at the red line. That is the units purchased by an SIP investor. It shot up. I mean, automatically you purchase more units when the markets are down, and vice versa. If the markets are expensive, you buy less units. I mean, there's a rupee cost averaging. So a simple tool is such a powerful tool to take care of the averages. And again, we have revisited all this. Just wanted to cover, I mean, why India is the fastest growing country. India has favorable demographics. The youngsters in India, skilled workforce, English speaking and competitive manpower, rich in natural resources, low penetration of consumer goods and improving affordability. Infrastructure needs are yet to be met. The reforms momentum, interest rates are low. There is a shift underway in global manufacturing from countries like China and other countries to India, and few other countries are benefiting. So when you are in India, why worry about average? I'm talking about the average line here. The average line, that's the long-term expectation of return expectation, will be healthy. So that's why you can simply it's one of the ways to deal with that uncertainty by simply doing asset allocation and SIP and listen to the expert. The three mantras is that asset allocation, the SIPs, and listen to your experts. That will take care of your emotional journey through these markets, and that is a possible way out to beat the inflation. Otherwise, why punish your money by simply earning returns that are less than inflation? So embracing uncertainty through these methods can be great. Just wanted to cover one more point, is that the other thing is that I like that we discussed the average I mean, laziness and forgetfulness. I mean, as human beings, as children, we are always taught that don't be lazy, don't be forgetful. I mean, these are negative attributes, like being an average person. So no doubt, laziness and forgetfulness are actually negative human traits. We accept that, but it can prove useful in stock markets for individual investors, for staying invested for a long period of time. So there is this invest and forget approach. So invest and forget approach, what does it do? See, the risks in equities reduces with long-term approach. We want you to be lazy. Just don't be having that urge to keep doing something. So today we need to do something. The more things you do, the more mistakes you make. I mean, just forget, invest and forget approach is very good. No need to lose sleep over market movements if you just forget. I mean, if you are not tracking the market, you will not lose sleep also. It will come up, don't worry. Just imagine a person who invested before COVID and forgot about it. I mean that's not possible. Everybody have the habit of keep checking the NAVs, etc. So no need to track your investments every now and then. Don't do it daily or weekly. I don't know if monthly is right. There is no science to it, but no need to do that. It doesn't make any difference. If there is a difference, then you are probably making some mistakes. Again, some of the quotes, people don't want you to be lazy. Like, do something today that your future self will thank you for. Do something today. Okay, you have to act and act now. Success is not easy, and it's certainly not for the lazy. These are all great quotes for most aspects of our life, but certainly not when it comes to the world of, I mean, getting inspired by these quotes can be harmful for individual investors in the world of equity. I mean, we are making starkly clear as to your behavior can impact your performance in the market. So let me tell you one healthy trend is that out of all the SIPs that people do with HDFC mutual funds, we have SIP investing, lakhs of SIP investors. 85%, 84% of them choose an SIP tenure of at least 5 years. That's very healthy. 73%, 10 years and above. So most of our SIP investors think long term. So you should also don't do an SIP for 1 year. It doesn't actually give you so much benefit. Do it for 10 years or do it till your retirement time. If you have 30 years of work life, do a 30-year SIP. We don't deny that. So I don't know if there is an upper limit. I have to check that, but definitely for 10, 15 years, etc., you can do an SIP. So we go to the extent of saying that food, clothing, shelter, and SIP. So it's a basic need. I mean, I would like to add asset allocation also. So food, clothing, shelter, asset allocation, and SIP are basic needs for every individual. Just one more data from here, then we'll quickly shift to the market outlook as to how the markets are positioned today. That also we'll discuss. Just one data point. So we have a chart here. Okay, I'll slightly hide this chart so that it's the HDFC Flexicap fund was started 25 years back. Its NAV is about 1,000 rupees today, 100 times growth. In this chart, it shows 875 rupees, but it's slightly dated. Doesn't matter. Just imagine a person who started an SIP in HDFC Flexicap fund on day one and still continues. By the way, I've personally found that there is another fund, Top 100 fund, which is also there for close to 25 years. There are 3,000 people who are still invested who came on board at the time of inception. 3,000 people have actually held on to their units for 25 years. I mean, for us, these are the superheroes. I mean, for not doing anything as far as equity investing is concerned. Just theoretically assume that somebody started an SIP of 1,000 rupees. So first month NAV was 10 rupees. So we all know that. So 10 rupees means you would have got 100 units. And so today the NAV is close to 1,000 rupees. So you get 1 unit. So you are continuing an SIP. So from 10 to 1,000 is the journey. What would be the average cost of this person? Purchase price, average purchase price of this person. Unfortunately, this is not an interactive session. Otherwise, I have asked this question in open forums wherein there is physical needs, etc. Most answers come, most people first say that 500 rupees, 10 and 1000. So the midpoint is 500 rupees. Some people, in fact, go even scientifically 505, etc., just to be exact on that. But I say that you are way too high. Your assessment is way too high. Your guess is wrong. Then they come down. Oh, yeah, maybe 200, 300 rupees. Is that 300? There is some benefit of compounding, etc. But I say that you're not even close. Then they bring it down to 200. But no, it cannot be less than 200 is the purchase price. Then I say the actual answer is 29 rupees. Then the room falls into a silence because people cannot believe that I've been investing every month 1,000 rupees, from 10 rupees to 1,000 rupees, but the average cost is 29. How is that possible? That's the magic of SIP and compounding. I mean, you buy most of your units in the first 10 years when the NAV is low. So that's the magic of compounding and magic of SIP, that if you do a long-term SIP, you buy in most of your units in the beginning stages of accumulation, and you watch them grow. And the reward is for not doing anything, not get excited when the market goes up and down and exiting the SIP. Unfortunately, we saw a lot of people exiting their SIP in the month of March last year. That was a mistake, because had not only they exited the SIP, they redeemed also. So that is like even a bigger mistake, because the markets are now more than double had they stayed invested. So we have to stay invested through the ups and downs of the market. That's a simple story. I'll shut down this presentation, then I'll quickly jump to the other presentation which I started with. Yeah, I'll skip all this. I think most of this. I'll skip a couple of slides. Okay, what determines the average line? We have discussed this, but let me show you a data point. This data is also a little dated, but it's okay. We are showing 40 years of data. If it is dated 1 or 2 years, it's fine. What we are trying to say is that you are seeing 4 bar charts, 4 bars in a chart, which shows the annual GDP growth of our country. So the blue color portion is the real GDP growth, and the yellow or yellow color is the inflation levels for the decade. So you have the 1980s, the 1990s, the 2000s and 2010s. You can see that on an average, the nominal GDP growth, that is the real GDP plus the inflation, has been close to 13, 14, 15%. So has been the rate of return in Sensex, which we discussed, about 14% compounding the last 40 years. So as long as the country grows, the markets have to grow. I'm repeating that, but since the data came up, I thought of showing this. I'll skip this also. Let me cover this also. The risk in the stock markets reduce if your holding period is longer. I told you that if it's a longer investment horizon, the less mistakes you make as an investor from a behavioral point of view. But statistically, sorry for the small font, but it's fine. So if you see the Sensex journey from 1979, which is 100 till now, I mean, this is also dated, but that's fine. On an average, the rolling returns, if you see somebody holding on the market for 1 year, somebody holding in the markets for 5 years, somebody holding their investments for 10 years, somebody 15 years. Statistics show that if you hold it for about 1 year, there is about 1/3 chance, that 33% chance that you will get negative returns. If you increase your time period to say 5 years, the risk falls from 1/3 to 1/10. There's a 10% chance, or less than 10, or it's about 10% chance. If you hold it for 10 years, there's 1 in 31. There's a very minor chance that you may actually make, because it happened during 1992 when the markets went up. You had invested all your money in the market and you waited till 2002. Then also there was negative return. That's an extraordinary situation. If you are invested for 15 years, you would not have made any losses. So it's statistically proven that if you invest for a longer period of time, there is less chance of making a loss in this market. Let's talk of some indicators today. So now we are shifting to the behavioral aspects of what is happening around us today. I mean, why is the markets high so much? The markets have gone up so sharply. See, I already told that the absolute levels of markets are not the right indicator. So what is the right indicator? We'll come to that. But we should also see that the economy has improved a lot after this pandemic. I mean, pandemic came 2 times. There was a first wave last year. There was a second wave this year. Third wave will happen. We don't know, but we hope it doesn't happen. But what we have learned is that post these waves of 2-3 months, the economy recovers very fast. I mean, it's not years that it takes for the economy to, it's only weeks that it takes for the economy to recover. When you talk of economy, there are, is it one portion of the economy that is doing well? Is it consumption only doing well? Is industrial activity doing well? Today, we observe that consumption indicators like auto sales, passenger vehicle sales, retail spending, labor force participation, unemployment, all are showing very healthy rate of recovery. Not just pre-COVID, some are actually going beyond the pre-COVID levels. There is this industrial and trade activity indicators like railway freight movement, power demand, GST collections, manufacturing PMI, all are showing healthy rate of improvement. So that is something really great. So it's not just that the markets are going, imagine the dog and the man. It's not just that the dog is going and the man is not moving. The economy is also moving. So we need not worry that. So it's not a time like 2008. We remember in 2008, the markets corrected sharply, but that was a euphoric time. Unimaginable amount of optimism. People are foregoing risks. People don't think that there is any risk in it. It's not that kind of an euphoric behavior today. So according to us, the market is neither very expensive or neither cheap. It's somewhere reasonably valued, somewhere fairly valued, so that you can invest for 5 years, 10 years. You should be suitably rewarded. That's our expectation. One thing that we want to stress upon here is that the Nifty 50 is trading at a PE of 21.4, assuming FY23 earnings as on September 30. I mean, that's a very confusing statement, but I'm not saying that you should have understood that in one go. But there is this PE, market PE, which is an indicator, whether a better indicator than absolute levels of markets. Says that it's a ratio of the levels of stock price versus the underlying company's earnings. That's a ratio. If the stock price goes up, is the earnings also going? That's PE, price earnings ratio. So it's at 21.5%. Now, is that high? Yes, it is high. Definitely not a cheap market. We're not saying it's a cheap market, so this is a great time. We're not saying that. We're saying that it's probably fairly valued because it should be considered from the view of current low interest rates and healthy corporate earnings outlook. I mean, a low interest rate scenario means higher stock prices because it's easier borrowing, and there's a concept of discounting which goes into ascertaining the value of a business. I mean, let me not go into the discounting and factor, etc. Generally, in times of low interest rates, stock markets are supposed to trade at higher levels, and that's what we are seeing. So that's no. I'm not saying that is we should not worry about it, but it's not a very big concern that you have to exit out of equities. We are also saying that there are the pockets of undervaluation in markets is also receding. There used to be a lot of sectors where undervaluation used to be there 6-7 months back, but those pockets are narrowing. For instance, in our opinion, auto, consumer staples, consumer discretionary, cement, IT services. Many sectors are today quoting at values which are higher than their own long-term averages, whereas sectors like PSU banks, electric utilities, metals, tobacco, we believe they are quoting at a slight discount or somewhere closer to their historic valuations in terms of price to earnings ratio, not absolute level. So why I'm saying is that it's not definitely a cheap market, but good enough to deliver not so disappointing returns from a 5-year, 10-year perspective. And these are also the sectors where we find there is attractive valuations that we have mostly positioned our portfolio. So this is our view. Our portfolio is overweight on those sectors where we believe there is good value that is there today. There is something I would like to add. I don't know how relevant this is, but let me also cover this also. In 2018, 19, and to some extent 2020 were years which we called as polarized years as far as stock market movement. When I say polarized years, very few stocks were responsible for the overall market movement. I mean, it's the 4 or 5 stocks in Nifty that were driving the Nifty, which was not a healthy sign, but that has reversed this year. So any trend typically mean reverts back to the mean. So this year, we have seen an overall participation in stocks, and most of our funds have started doing well. I mean, during times of 2018 and 19, a few stocks were only responsible for the market growth. Unless I have a skewed portfolio, it's very difficult to keep pace with the market indices. So we did have some performance challenges in 2018 and 19, but currently, if you see our 3-year returns, 5-year returns around, have improved significantly for most of our funds. Then concept of mental accounting is important. How do we describe the concept of mental accounting? I mean, let me give you the example of the PF amount that gets deducted from our salary. Every month, as for salaried investors, if you are a salaried investor, every month the EPFO money, the PF money gets cut, and it's there somewhere, which is not available for our easy use. You can redeem with some restrictions after some time, but just imagine, what is this money meant for? It's meant for your retirement corpus. I mean, you should have a reasonably good retired life. For that purpose, this corpus exists. So you mentally allocated that money. Can you imagine you withdraw that money and buy a car or go for a foreign trip? You'll not do that because there is an element of guilt attached with using money meant for certain purpose for some other purpose. For instance, if you have mentally allocated some money for your children's school fees, obviously you will feel guilty for using that money to buy something else which is less trivial, say buying a home theater or the expensive shoes or something like that, because mental accounting is always we have seen this many times, that mental accounting is a reality. For instance, many people don't value the bonus as much as they value the salary. Bonus is a bonus. It's meant for splurging. So they typically increase their spending at the end of the year when they get their bonus. But that's your hard-earned money as well. So mental accounting is evident in many aspects of our life. Like, I don't know, women doing kitty party. I mean, women doing kitty party, what they do is that I've seen they every month pay some money, say 5,000 rupees or 10,000 rupees. 10 of them get together, and somebody's name comes up on the chit, and that person gets all the money, and they get excited to spend that money. And the rest of the 9 months they pay up. I mean, it's there is no value addition here, but it's like mental accounting. It's the time to spend. there's no actual value addition in that, but people still enjoy. Each one of us, we are humans, and we undergo this mental accounting, but you can put this mental accounting to a great use. For instance, there are retirement mutual funds. Instead of investing in a normal fund, if you invest in retirement mutual funds, which come with the 5-year lock-in, the chances are that you stay much more focused and disciplined till you reach 60 and hold on to it, rather than using it for some other social requirements or any other aspirational needs that you have during the course of 30 years or 20 years that is there. But there is another category of mutual fund, which is the children's fund. We have HDFC Children's Gift Fund. That is also a fund meant for building a corpus for your children's welfare, their education, marriage, and other requirements that have a financial implication. So save with a goal, and there is a chance that you stay focused and disciplined and do not end up spending that money for less important things or other things. Wanting to give you an example, there are hybrid funds. We have HDFC Hybrid Equity Fund, HDFC Multi-Asset Fund, HDFC Asset Allocator, HDFC Balance Advantage, Equity Savings Fund, HDFC Hybrid. There's many, I think 5 or 6 hybrid funds that we have, which varies from different exposure level of equities. Some has 65%, some has 70%, something has 50%, something has 25%, something has 40%. You can get that information from our branches or through your investment expert. Mr. Ramalingam can help you out. What I'm trying to say is that when you come into a hybrid fund, what happens to you? Let's take an example. See, we are human beings, we fear loss. Even the great Harry Markowitz fears loss. We expect each investment to go up. We have made investment in 10 places. We want each one of that to go up. If we feel defeated or are left with a sad feeling if one of it goes down also. But in the world of investments, from time to time, different asset classes do well, not do well from time to time. If you see on the right side, there is a table, equity and debt. Some years equity do well, some years debt does well. But on an average, equity has done well for a longer period of time. But if you see, there is a table on the left side. Here. Oh, how do I write? Yeah. If there is an investor who has invested in 4 investments, one has given 7% return, one has given 10% return, one -5, one -10. These 2 are okay. We are happy. These 2 are bad. But from time to time, markets will test us with such kind of results. What do? We actually become emotional and we exit out of the investments that fall. That's a instinctive reaction of most investors that we have seen. Now, let's take a case. Okay, so there are 2 investors, investor 1, investor 2. One investor invests in equities separately, debt separately. The other investor invests in a hybrid fund that has equity and debt in the same proportion as the investor 1. This investor has 25-75 split separately. This investor invests in a hybrid fund that has a 25-75 split. Now, effectively, they have done the same thing. But let's assume that in the first year, the equity markets falls 5%. Equity has given 5% negative return. Debt has given, say, 7% return. Because of the split of this investor 75-25, the net returns of the fund is 4%. Now, this investor 1 is likely to sell the equities at a loss. Oh, this is a bad fund. Why did I invest in a bad fund? Let me sell. This investor holds on to the debt. In fact, he sells that money and puts that money in debt. So he becomes 100% debt. This person continues with the fund, which becomes 77% debt and 23% equity because the equity has fallen. Now, next year, the equities return 30%. And this person who has sold equities does not participate in the upside, has participated in the downside, but has not participated in the upside. Now, what happens is entire money grows only 7%, right? So now his 100 rupee at the end of 2 years would have become 111. Whereas this investor, the 100 rupee becomes 116. Now, what is the difference? They took same decision, 25-70. Only thing is that this person has redeemed because of the emotional, emotional journey leading to irrational decisions and not able to encounter volatility, loses patience, loses discipline, and loses long-term orientation. So automatically a hybrid strategy brings with you a long-term orientation, discipline, patience, and ability to undergo volatility. It cushions the impact of volatility in equity. So that is the advantage of a hybrid strategy. I mean, it's the same investing. I mean, you can say I will go for the best equity fund, I go for the best debt fund. Why go for a hybrid fund? I'll say go for a best hybrid fund. In fact, choose the fund house. Choose the fund house first. Do your asset allocation first. Assess your risk profile. Choose your fund house first. Then choose your product category. So that's a proper step, I believe, is better and more rewarding in the long term. I think we are now 1 hour 15 minutes through our discussion. We've come almost to the end of it. I think I'll wind up the discussion. I think we have covered it in quick time. Let me try and stop the screen. Yeah. So that is it from my side in terms of why you should invest in equities, how you should, why it's important. You have to, first of all, let me summarize this. You should not avoid uncertainty. You should embrace it. And there is a method to it. There you have weapons. The weapons are asset allocation, SIPs, listen to your expert. And fourth is maybe you can go for a mix of hybrid and listen to your mental accounting instincts. And that's how, see, ultimately you have to grow your overall portfolio. You need to have some equities in your mix of investing. So that's important. And these are the weapons you have. And it's not a bad time to invest in equities. That's what we understood from the market outlook. So with that, I'll conclude my presentation or my initial remarks. It's a lengthy remarks.